34.1%. That is how much value is comprised by my top 5 dividend stocks that I own in my personal dividend stock portfolio. I actually own 51 stocks. Of the 51, 49 pay dividends. 2 of them will probably pay dividends, hopefully in the future. But what's so interesting is I have a long tail of dividend stocks in my portfolio, but I really focus heavily on the top core positions. And that's why my top 5 comprise 34.1%. I want to cover that in the video today. I've done these videos before on YouTube, but I think this one's going to surprise you because if you looked at my portfolio a year ago and you look at it now, that top 5, it's a little bit different. It's different than what you would expect because I've been making a lot of big trades in my portfolio, a lot of big buy orders. And so I want to go through that. I have some bonus content I want to share in the video as well. I'm going through a strategic portfolio audit right now, and so I'm excited to surface some insights with all of you of what I've learned as I've gone through my portfolio, starting with these top 5 core amazing positions that increase their dividends like clockwork over time and pay me money, passive income while I sleep at night. Get ready, everyone. I have a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So before we get started, just a quick shout out to my patrons, my corner patrons over on Patreon. I will link in the pinned comment below. I'm going through a strategic portfolio audit right now, and I'm going to share my complete portfolio percentage value allocation to each of my 51 positions with Corner Patreon later this week. I'm going to share the portfolio with the value percent of each position and also a little video to go along with it as well. But I've already shared a few videos in the strategic audit series over on Patreon. So check that out in the pinned comment below. All right, everyone. So I want to share some summary and some insights before I dive into the positions. Check it out on the screen right now. And so I own 51 positions, 49 pay dividends, as I mentioned. Now, the overall portfolio right now on a current yield basis, if I just take the current dividend cash flow that I'm receiving, I divide by portfolio value, I'm getting a current portfolio yield in that 3.2 to 3.3% range. I'm mentioning this statistic because so many of you have been asking for this for a while. And so this statistic is exciting because what it shows to me is the current yield of the portfolio. It's in a range that I'm used to seeing. It's in a range that I'm familiar with. It tells me that the market right now is not overvalued. It tells me that the market is not really undervalued either. But what it also tells me is I'm hitting a sweet spot that I want to hit. I have a current portfolio yield that optimizes for current cash flow, dividends that I can use to pay bills right now, although I'm reinvesting most of them, but it also optimizes for dividend growth as well, which is so important because I'm investing for the long term and I want to have optimal cash flow when I look out 1, 2, or 3 decades. And so as you can see on the screen in front of you right now, what I also want to share is I'm going to go through my top 5 positions today by value. They comprise 34.1%. If I were to critique myself, I would like to see this closer to 40%. I really want to heavily weight in my top core positions. And the way that I'm doing that is I made a rule. Going forward, I'm really only adding to core positions right now. Now, my top 5 is not my only core positions. When I say core positions, I'm really thinking of my top 10 or 15, but still I'm only adding to core positions. And that's so important of a rule that I had to make because I get distracted sometimes by adding to my ancillary positions. Now, my top 5 positions, if I were to weight them by cash flow, by dividends, that top 5 list, it's a little different than the first top 5 list. I'm going to go through that today as well. The top 5 by cash flow comprise 31.2% of dividends. And again, there's some overlap, but not complete overlap between the two lists. versus my last portfolio update, which I did share on Corner Patreon on May 16th, my portfolio value, it's actually down 1.78%, even though I've been adding money. That shows you where our market's been headed. But my dividend income, it's up 3.4%. And so it's so exciting to see that spring, if you will, it's compressing. My portfolio value is going down, but because I keep adding more money, because dividends keep increasing, because the companies that I invest in keep doing really well, because I keep reinvesting dividends, the spring is compressing, if you will, so that when the market does finally rebound or surge in the next bull market, that spring will just pop right open. But what's so exciting is even though my portfolio value is down slightly, dividends are way up 3.4%. And if that's been about 6 months since that last update. So that shows you I'm probably increasing my cash flow by about 3.4% every 6 months, or about 6.8% per year, which is pretty good. I'd like to see it even closer to 7 or 8% if I were to critique myself again, but also not bad. So let's jump into it. Position number 1 by value in my top 5 list. It's probably going to surprise you because I just did a video about Starbucks being number 1, but no, it's not number 1. Check it out on the screen right now. My number 1 dividend stock right now by value, it's actually Johnson & Johnson. Starbucks and J&J bounce back and forth. Right now, J&J is 8.8% of my portfolio. And I'm going to kind of go fast today. I'm going to do this in a speedy fashion. A lot of you have seen these metrics before. So if you want to delve into all of the metrics, just go ahead and pause the video and look at the screen. I have all the metrics there. But I just want to go kind of quickly today. Johnson & Johnson comprises 8.8% of my portfolio. And what I love the most about the company right now is it's trading at a bargain PE ratio. It's trading at value. I'd say what I don't like about the company is the dividend. I wish it were growing quicker. 6.1% doesn't cut it when I'm trying to grow my overall portfolio cash flow by, say, 7, 8, or maybe even more per year. It's not quite cutting it. But their payout ratio is low enough where I do think they could increase the dividend quicker than they have been. In terms of pros, again, it has a reasonable PE. It's a mutual fund of sorts in that it has pharmaceutical investments, it has consumer healthcare and medical devices. And so it's a very diversified healthcare company, a mutual fund of sorts. And I love its historic stability. But what I don't like is that mutual fund is going away because they're splitting it into 2 companies. They're going to spin off the consumer division. I don't like the increased litigation risk. I don't like the slower dividend growth. And so that's J&J for you. My number 2 dividend stock by value, it's only slightly smaller than J&J at this time. It's Starbucks. It comprises 8.7% of my portfolio right now. And so given the week, if it's one of them's trending up, one of them's trending down, they kind of go back and forth, but they're really close. They're really close to each other. Here's my Idaho cup, by the way, from Starbucks. I now live in Idaho, so I just had to have this one from Starbucks. I really like this series. They make really nice mugs. A lot of cool cups and mugs over there at Starbucks. I know some of you are a little tired of hearing of Starbucks, so I just got to say Starbucks, Starbucks, Starbucks. No, I'm just kidding, but I'm going to go through it really quick because I know some of you are tired of it, but check it out on the screen right now. Starbucks, honestly, the main thing I want to highlight is that it's 27.7% off its 52-week high. That always captures my attention when a core stock is down that much. It gets me excited because I like to buy core stocks when they are trending down. And what I really love is the 5-year dividend growth rate is 12.1% per year on average. Again, I told you I'm trying to increase my dividend cash flow by, say, 7, 8% per year portfolio-wide. Well, a lot of that growth comes through reinvesting dividends. A lot of that growth comes through adding net new capital. But a lot of that growth as well comes through dividend increases. And if I can own big companies like Starbucks and they can comprise big portions of my portfolio, like 8.7%, well, if they're going ahead and doing the heavy lifting by increasing the dividend by 12.1% per year on average, boy, that works wonders for me. That makes it easier for me. That makes it so I don't have to add so much capital to the portfolio. The investment itself does the heavy lifting. What are the pros of this company? Exceptional growth, excellent innovation and reinvention, rapid dividend growth, which is really important to me. Cons, and why it's trending down a little bit right now, is exposure to China, and it appears that the Chinese economy is starting to slow. It's not necessarily a necessity during rough times, but time will tell. If times are rough, will consumers give up their expensive coffee? I'm not so certain, but it is a risk. And quite frankly, even though it's down 27%, it is still expensive. So I've got my first stock at 8.8. I've got my second stock at 8.7. We're going to dip down to the third stock right now. As you can see on the screen right now, it's PepsiCo. It's at 6.7. So it's still really big. This is a big allocation to PepsiCo. And I think what's going to surprise a lot of you watching at home is these are big percent allocations that I'm giving to these companies. Hopefully, I'm really stretching myself, challenging myself to go even more aggressive on my favorite companies. What I am highlighting with PepsiCo is it's only off its 52-week high by 1.5%. That goes to show the strength and resilience of this company during bad times. Right now, times are bad. The market is going down. I think the market could go down a lot further, but this is a really blue chip. It's the bluest of blue chips holding its value. What I also highlight, even though it's nothing to write home about, but boy, the payout ratio now is only 67.9%. I'm used to seeing that in the 70s. What that tells me is despite the rapid dividend growth of 7.4% per year on average, the payout ratio is coming down. So not only are they increasing the dividend quickly, but they're also growing earnings so quickly that the dividend is comprising less and less of earnings, which gives them more power in the future to increase the dividend even more. As you can see on the screen right now, I love the strong performance during all economic cycles. I love that it's a high-quality blue chip. I look at it almost as a store of value at this point. It seems as if this stock is just so resilient, it's hard to have it trend down at all. Strong dividend growth. It is expensive in terms of cons, and also I only have two cons here. Maybe this is one of the only ones where I just couldn't come up with a third con. But really, can they continue to grow? I feel like they've probably saturated a lot of their growth. And sure, they have pricing power, so they can grow through increased pricing. But have they saturated a lot of their growth? Are there new product categories they can go into? Maybe at Frito-Lay, can they do more snack foods? Is there something they can do? I just get a sense kind of, hey, how much more growth is ahead. Now, we're going to go into my number 4 largest company right now, and it's another restaurant stock. So we went through healthcare. We went through restaurant. We went through consumer packaged goods food. We're going to go back to restaurants, but it's restaurants and also real estate. So as you can see on the screen, it's McDonald's. It's 5.5% of my portfolio. And I don't have a lot to highlight here other than they just increased the dividend quite a bit, and their 5-year dividend growth rate on average is 8.5%. I'm telling you, my goal here is to increase portfolio-wide cash flow by 7-8% per year. I can do that by working so hard and deploying a lot of money in the market. But honestly, as my portfolio gets larger, net new capital as compared to portfolio value can only do so much. So I really have to rely on companies like McDonald's that can do the heavy lifting for me. And they're growing the dividend on average by 8.5% per year. And so that's huge. It does the heavy lifting for me, true passive income. In terms of pros, I love the rapid dividend growth. I love their seemingly recession-proof business. They're offering low-cost food that customers need during good times and bad. I love their iconic real estate portfolio, which is carried at purchase price on their balance sheet. In terms of cons, I would say it's kind of like PepsiCo. Can they continue to grow forever? Haven't they saturated the market? It's just amazing how they continue to grow. But at some point, haven't they saturated the market? Also, in terms of cons, boy, it has a strong valuation at a PE of 26 this year, 24 next year. And quite frankly, in terms of cons, I think a lot of people mistake this company as having no risk. But what I would say is food preferences over time may change. Consumers may get a little bit more healthy. Quite frankly, they're dealing with a lot of meat, a lot of beef, chicken at this company. Could something go wrong at some point? They have to be awfully careful about food quality at this company. And so I think there is some risk there, both with kind of changing consumer habits, but also just keeping the quality of their food distribution and supply top notch. And so, of course, none of the stocks that I'm mentioning are without risk. They all have risk. And with that, I'm going to go on to my 5th position today. But before I do that, if you're enjoying the video so far, please go ahead and drop me a like. It really means the world to me. It helps me out here on YouTube growing my channel. And so number 5, it's totally going to shock you. Before I go on to number 5, just drop a comment. Put what you think number 5 is. I bet you no one's going to get this one. You're going to be surprised. My patrons probably already know or have a good guess. But if you're not on Corner Patreon, you probably aren't going to guess this one. Let's just do it. Check it out on the screen right now. It's Apple. Believe it or not, number 5 is Apple, coming in at 4.5% of my portfolio's value. It's surprising. I've added a lot to this one over the last year. What I love about Apple, quite frankly, is the payout ratio is just so low that there's an evergreen opportunity to grow cash flow, grow dividend cash flow. And I like the 5-year dividend growth rate of almost 8%, 7.9, right around my target range. Now, I like to see that even higher for Apple because the starting yield is so low and the payout ratio is so low. Nonetheless, it works because my horizon, my investment horizon, is so long. Pros, it's an iconic brand, iconic user experience, iconic design. I think they can go into almost any product category and capture the hearts of consumers because consumers just want to own Apple products. And this is a must-have portfolio of products. You really can't live without it, or I can't live without Apple products in my humble opinion, and a lot of other consumers are just like me. Low payout ratio gives them a lot of room to increase the dividend. In terms of cons, boy, that starting yield is low. It's not very meaningful in terms of cash flow contribution with a starting yield of only 0.6%. Dividend growth, honestly, especially the last dividend increase, it's been a little slower than I'd hoped for. Customers also, maybe they won't upgrade to the newest iPhone. Maybe they won't upgrade as quickly as they have in the past during rough economic times. And I think a lot of us know instinctively, intuitively right now that we're headed for rough economic times. Put in the comments below what you think. Do you think the economy is going to rebound here, or do you think it's going to be bad for a while? By the way, I just got to show this. I'm going back to McDonald's, but hey, I got Grimace. The adult Happy Meal. My wife got it, thankfully, before they sold out for me at McDonald's. And here's the retro Grimace. This is the one I wanted. And so I am loving it. I'm so happy I ended up with Grimace. All right, everyone. I want to head on to the next segment of the video. Before I do, if you enjoy the video so far, don't forget to subscribe because I do have new videos here all the time on YouTube and you don't want to miss out. The next part of the video, I want to quickly go through my top 5 by dividend income contribution. Again, I've already gone through my top 5 by weighting. Now it's by dividend income cash flow contribution. And so thankfully, the first 2 are the same. And I like seeing that because it makes me feel good to see some consistency. As you can see right now on the screen, Johnson & Johnson, whereas it's 8.8% of my portfolio's value, it comes in at 7.2% of dividend income. And so I'm not going to go through all the metrics again. It's all the same. J&J is number 1 in terms of income. And so number 2, I want to say Starbucks, Starbucks, Starbucks. I'm just kidding, everyone. I know you're tired of Starbucks, but check it out on the screen. Starbucks now comprises 6.7% of my dividend income. I really like seeing that because they're growing the dividend quickly. And so that 6.7% contribution, it's a big amount. It's a big dollar amount, and it's going to keep getting bigger. All right, everyone. Number 3 is going to shock you because so many of you are like, Ian, did you sell this stock? No, I didn't sell this stock. I'm not going to sell it. It's a position that's not on the first top 5 list, because again, the second top 5 list is by dividend income contribution to my portfolio. You're going to get a kick out of this. Check it out. It's 3M. 3M now contributes 6.5% of my dividend income. So just a little bit less than Starbucks at 6.7. And 3M, I want to take a minute on this. It's down 36.4% from its 52-week high. The market hates this. I just did a meetup on Corner Patreon on Zoom recently, and one of the patrons was saying, hey, I'm buying 3M now because I just got to go and buy what everyone else hates. That was a really interesting strategy. I appreciated that. I can't bring myself to buy more because it's such a big position in the portfolio and it contains so much risk. That being said, I'm reinvesting dividends, and I love the forward PE in the 11s. I love the starting yield of 5.03%. In terms of pros, this is a total classical contrarian pick. Everyone hates it. It is a huge starting yield, low PE ratio. In terms of cons, there is some serious litigation risk. Serious. I don't like that they're spinning off the healthcare division. I like it better as one company. Is it a possible yield trap with all this litigation risk? Honestly, it could be. And so that's number 3. Number 4 is another net new stock I have not discussed yet. I'm happy, actually. I've worked all these years to try to lessen the exposure I have to sin stocks because they're risky. That being said, I like that one of them still pops up in my top 5, at least the top 5 by dividend cash flow contribution. As you can see on the screen, rounding up number 4 here is Altria at 5.5% of my dividend income. I like this one right now. Maybe I'll buy some more. It's trading down 19.8% from its 52-week high. PE is even lower than 3M's. It's in the 9s. Starting yield even higher than 3M's. It's 8.22%. Picture this. I'm telling you I want to grow my cash flow each year on average by 7 or 8%. Well, here, let's put aside dividend increases. They're increasing the dividend on average by 7.3% per year. But let's just put that aside for now. Let's say they can't increase the dividend anymore. Well, if I get a starting yield of 8.22% and I reinvest that yield into more shares of Altria that yield 8.22%, that alone satisfies my goal. Now, if you factor in the fact that I add more money into this, that I reinvest dividends, that they increase the dividend each year, boy, this is going to get me to my goals of increasing portfolio-wide cash flow pretty darn well. Now, what I would say about Altria is it has an incomparable dividend yield. It's almost always on sale because people don't like buying sin stocks in 2022. It almost seems like it's a destruction-proof company because I think there's forces that are always trying to destroy this thing, like bad acquisitions, consumer sentiment, political policy, so on and so forth, but it always seems to survive. Cons, hey, it's a sin stock. So many people frown upon it. Volumes are in decline since the 70s. And boy, they had terrible issues with Juul. What a mistake purchasing Juul. And so the 5th position that I want to share today by dividend contribution, it's one you've already seen. It's actually my number 3 by portfolio percentage value. As you can see on the screen, it's PepsiCo. So PepsiCo contributes 5.3% of my dividend income. And so it's nice to see at least 3 of the positions on this second list are the same as the first list. And of course, you would never expect Apple to be on the second list just because the starting yield is so low. And McDonald's does not make the second list, but I am sure it is very close. I don't have that in front of me right now. All right, everyone, I hope you enjoyed the video today. If you do, please go ahead and drop a like. It means the world to me. It really does. And I hope to see you in the comments below. We always have such great discussion here on PPCE and dividend stock investing for everyone. Before I go, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose money in the market. I'm just sharing my personal journey here on YouTube for fun and entertainment. This is not investment advice. And so also before I go, in terms of a full disclosure, I own the stocks mentioned today. I am long Johnson & Johnson, ticker J&J, PepsiCo, ticker PEP, Starbucks, ticker SBUX, McDonald's, ticker MCD, Apple, ticker AAPL. I am also long 3M, ticker MMM. I am also long Altria, ticker MO. I wanted to do that all by memory today. I think I got them all. I love you all. Thank you for your support here on YouTube. I will see you in the comments below, and I will see you in the next dividend stock investing video.